The COVID-19 pandemic has exposed the limitations of numerous quantitative asset managers. On February 11, 2020, the virus was isolated at name, and yet 8 days later, the Standard & Poor's 500 continued to climb, reaching an all-time close level. Many quantitative firms subsequently suffer substantial losses, and this is even true among funds that offer market-neutral strategies. A few investors have used this opportunity to promote their Black Swan funds. And while Black Swan strategies seem like a good idea in theory, the empirical evidence appears to indicate that these strategies lose money in the long run due to the high cost of continuous market insurance. Therefore, it is important that we extract the right lessons from the COVID-19 debacle. In this presentation, I'll explain 3 important quant lessons that we can learn from COVID-19. The first lesson that we can extract is that we need to do more nowcasting and less forecasting. What do I mean with that? Well, what I mean is that traditionally in finance, we have relied on forecasting. We have used structured data to make long-range predictions. You can think, for instance, of the case of startup funds and CTAs, where they use price time series dynamics to make forecasts for relatively long periods of time. Or the case of asset managers that apply, for instance, factor investing to evaluate whether a security is cheap or cheap, and they utilize cross-sectional data in order to make that evaluation. In both cases, the common denominator is that forecasting involves statistical relationships between lag observations and future outcomes. These lag observations do not always hold. In fact, they tend to be quite fragile over time. And number 2, forecasting, because it relies on these lag data sets, typically is very backwards looking, is not adapting quickly, and the data sets are limited with sparse observations that are not updated frequently, etc. So that's the typical econometric approach to forecasting. In contrast, nowcasting relies on unstructured data to do essentially 2 things. Number 1, direct measurements, where the target variable is directly observed. Consider the case where we are nowcasting inflation. We are making real-time estimates of inflation, not based on macroeconomic data, not based on lag information like electricity consumption or unemployment, wages, wage pressure, etc. No, we are nowcasting inflation by collecting millions of observations from websites that publish online prices. If we do that, we are not making a guess of inflation based on some statistical relationship. No, we are measuring directly the variable of interest. In a second application of nowcasting, we could also make short-range predictions, but where the cause-effect mechanism is very well understood. For instance, the target variable could be whether the estimated revenue of a retailer, and what we use as an index is parking lot occupancy, which we assess by analyzing satellite images of parking lots. In this case, we know that there is a relationship between parking lot occupancy and sales at the shop. It's not a statistical guess. We have a very strong connection between the two. And rather than trying to predict revenue by looking at 10Ks, 10Qs, financial disclosures, etc., we are linking revenue with something that we can evaluate in real time. What I'm showing you on this plot is the case of the Billion Price Project, where they collect daily price fluctuations from tens of millions of websites. and across the globe. And as a result, they are able to nowcast inflation very accurately weeks before the official release is published. The advantages of nowcasting are at least three. Number one, these direct measurements always hold true. When we are measuring inflation directly, we are not guessing a particular relationship. We are evaluating the target variable by collecting millions of independent observations that are not perfect, but given the large sample size, the noise tends to cancel. The second advantage is that short-range predictions tend to be statistically more reliable and stable than the long-range predictions that are involved in forecasting. And in any case, we are making all of these estimates based on a large number of observations that come from many different contributors. We are not relying on a single data source, etc. Nowcasting is in fact quite common in the scientific fields. For example, we are not able to forecast earthquakes, and yet we can nowcast the effect of earthquakes. We can utilize nowcasting to warn populations that are likely to be impacted by the shockwave minutes before the shockwave reaches that area, thus saving thousands of lives. What this means is that when you nowcast a variable, you may be able to obtain benefits very similar to a perfect forecast. The plot I'm showing you here is the tsunami progression of quantitative models that occur 5-10 hours after the earthquake hit in Sumatra. What this means is that utilizing nowcasting, we were able to warn populations 5-10 hours before the tsunami reached this coast, saving tens of thousands of lives. Similarly, in finance, we can utilize nowcasting to be able to adjust our portfolio before a particular effect impacts the markets. In fact, if we can nowcast something, we should not forecast it. Forecasting is essentially a mathematical guess. And better than guessing is to measure the conditions of a variable in real time. I have referred before to the example of inflation, which is extremely helpful for FX traders and fixed income traders, etc. But there are many other examples. One of my favorite examples is market makers utilizing fixed messages to evaluate the probability that there is an informed trader. And this information is extremely helpful to determine whether they should widen or narrow their bid-ask spread. Well, they are nowcasting. They are not predicting whether whether an informed trader is going to interact with them. They're measuring their presence in real time so that they avoid providing liquidity at a cost. Another example would be retailers who publish earnings every quarter. Well, we could estimate in real time whether a retailer is having a good or a bad season. The plot I'm showing you on the right does precisely that. A data provider evaluated email receipts at the end of 2018, and from that they deduced that Best Buy was having a much better season than Target. And they were able to reach that conclusion months before retailers published the information. Another example is industrial production. We can utilize engineering data sets, cargo shipments, auto production numbers, electricity consumptions, a wide range of data sets in order to evaluate the level of industrial production of various companies. Let me give you an example of how to deploy nowcasting strategies in practice. First, we are going to identify a cause-effect mechanism. For instance, we could determine that unemployment impacts consumption, and consumption impacts retailers' revenue. This is not a guess. We know that people who are employed tend to consume more. In the second step, we develop an investment strategy that monetizes that mechanism. For instance, we may decide to buy retailers with a strong presence in regions that are exhibiting an increase in employment. And we may decide to sell retailers that have a strong presence in regions that are exhibiting a decrease in employment. In the third step, what we do is we evaluate the performance of this trading rule while assuming perfect knowledge of the information. So assuming that we know in advance the unemployment data, how profitable would this strategy be? Well, if the strategy is not profitable with perfect information, then we can scratch it and do something else. But if the strategy happens to be profitable, then we go to step number 4, and we replace the perfect knowledge with the nowcasted estimate. In this way, our model is not biased by the noise or the errors in our nowcasting. We know that the model has been trained utilizing perfect information. And then we replace this perfect information with the nowcasted estimate. And again, the important is to avoid that a strategy is fitted based on a statistical fluke or on erroneous data. That we know that the strategy is going to work if we feed the strategy with valuable information, and that's what we do through nowcasting. What I'm showing in this plot is that satellite images of the night sky clearly indicate what areas of what portion of the Korean peninsula is associated with the country of South Korea and what portion is associated with the country of North Korea. Clearly, light at night indicates what region exhibits economic activity, and the amount of light, the number of lights, and the reflection also indicates whether there is an increase in economic activity at a particular point in time. We could also look at traffic and geolocation data to evaluate economic activity and whether individuals are moving, are they commuting, etc. There are many ways in which we can evaluate economic activity in real time. The conclusion here is that there are no black swans if we have a good grasp of nowcasting. If we can evaluate economic conditions in real time, we will not be surprised. We are surprised if we try to manage our portfolio by looking at CNBC. But if we have access to detailed microscopic data, then we can evaluate when there is an impact that is unexpected. For instance, days before COVID-19 sell-off started, there were many different early warnings that the virus was disrupting the critical supply chain in China. The plot I'm showing you to the right indicates how copper prices dropped significantly days before the S&P collapsed. Why? Well, because companies, industries, did not need to buy this copper. They had an inventory and they were not using it, therefore they ceased to buy, and the demand plummeted and the price plummeted. There are many other indicators when you look at geolocation data and traffic data and battery usage from electric cars. All of these indicators demonstrated that COVID-19 was impacting the Chinese economy. And those who utilize these nowcasting tools were not surprised. For instance, market makers had a great month in March. Do you remember how market makers fared during the flash crash of May 6, 2010, they lost a lot of money. And yet they had a great month in 2020, in March and April of 2020. Why? Because today market makers nowcast order flow imbalance. They have automated the analysis of fixed messages, looking for evidence of large traders, of uninformed traders, and they avoid adverse selection that way. So what I'm saying is that black swans are not something that necessarily occurs. Black swans are the result of working with flawed information. If you have access to real-time information, you are not going to be surprised. Every black swan is a white swan. The second lesson that we can extract is that we should develop theories, not trading rules. What I mean with that is that in finance, we are over-relying on backtests to develop investment strategies, and that's wrong. The purpose of backtesting is to validate, to evaluate the profitability of a particular investment strategy. The purpose of backtesting is not to research an investment strategy. Backtesting is misused by academics and practitioners to develop trading rules, where these trading rules have no connection to economic theory. For instance, it's very common for academics and practitioners to run tens of thousands of historical backtests and report to a journal or to investor the best possible outcome, therefore hiding all of the losses associated with failed trials. Well, of course, this leads to false discoveries and overfitted backtests. Instead, what we should do is we should develop theories where we understand the cause-effect mechanism. We understand where the money comes from. And once we have these theories, then we utilize backtesting to refute a hypothesis. You see, a backtest is only useful when it refutes a theory. If it confirms a theory, well, it could be that this strategy makes money because of the theory or for some other reason. Backtesting is one tool we can use to refute a theory and evaluate the economic potential, the profitability of a particular strategy, but it's not confirmation that the theory is right. In order to fully, thoroughly analyze and evaluate a theory, we need to go beyond backtesting. We have to look at the full implications of a theory. And this means that, for instance, if we have a theory that market makers widen the bid-ask spread in presence of imbalanced order flow, we go and check how various market makers reacted when order flow increased. So we will go to the fixed message of a particular exchange, let's say the CME. We will evaluate for every minute of every day what is the order flow imbalance. If order flow imbalance spikes, we will go to the P&L of market makers and we will see if they lost money and whether they widened their bid-ask spread. Those who lost money, did they widen the bid-ask spread, or did they continue to operate with a narrow bid-ask spread? So this is what allows us to thoroughly check a theory rather than just running some backtest that could be profitable as a result of lack or a spurious relationship. In particularly in finance, we need to avoid this circular reasoning where we utilize backtesting to come up with trading rules, not theories, trading rules. And then once we pick the best trading rule, we submit this trading rule to a journal or an investor, and then the investor and the journal will utilize backtesting to analyze to evaluate the same trading rule that was discovered through backtesting. This sort of circular reference just means that most investment strategies are going to be false. We need to develop theories and test those theories in many different ways, where backtesting is just one way of accomplishing that. Lesson number 3 is that we should avoid all regime strategies. What do I mean with that? Well, typically in journals and when you talk to investors, typically what they do is they evaluate an investment strategy, and there are many different market regimes, sometimes going back 20, 50, 100 years. And what is the problem with that? Well, it is very likely that an investment strategy that appears to have worked for 100 years, in fact, is a false positive. Why? Because markets learn, market participants do not make the same error consistently. Eventually, they are put out of business, and the replacement doesn't make that mistake. So when an investment strategy appears to work for such a long period of time, most likely is we are talking about a false positive, just a spurious trading rule that appears to be profitable as a result of trying millions of alternative trading rules. And of course, there will always be a trading rule that appears to work if you try hard enough. So this combination of, on one hand, markets are adaptive, and on the other hand, investors learn from mistakes. What it means is that looking for all regime strategies is a futile endeavor. These sort of holy grail strategies are extremely unlikely. But even if there were some holy grail strategies, the reality is that they are only a subset of the complete universe of possible profitable strategies. What I would suggest is that instead we develop investment strategies that work well under well-defined regimes. For instance, we could develop an investment strategy that profits from an inflationary scenario, or an investment strategy that profits from a panic situation, or from a situation where investors are greedy, like a risk-on scenario, or a situation where investors are running out of the market, like in a risk-off scenario. Another set of strategies that profit from an expansionary monetary policy, etc. If we do that, we are developing strategies that are not supposed to work all the time. But guess what? We can utilize nowcasting to determine in what regime we are. For instance, we can utilize nowcasting to determine whether we are in an inflationary scenario, as I explained earlier in the presentation. And we can associate that estimate with a probability. For instance, we can say, well, there is an 80% probability that we are in an inflationary scenario. Well, that means that we should allocate an 80% of our capital to these sort of strategies, to the ensemble of strategies that are supposed to work well in an inflationary scenario, and 20% to the rest. So by nowcasting, the probability that we are in a scenario A versus scenario B versus a scenario C, what it means is that we are always invested in an ensemble of investment strategies. We're not putting all the eggs in a single basket where this basket is supposed to be successful all the time. We are allocating assets based on the probability that we are in a scenarios where the strategies that we use for each scenario are optimal to that data generating process. This is much more dynamic and much more adaptive and forward looking than relying on backtests. In particular, we can utilize knowledge graphs to make these sort of decisions. For instance, suppose that we have a knowledge graph based on business ties, another knowledge graph based on the supply chain of a series of companies, another knowledge graph that links companies based on their competitors, another knowledge graph that links companies based on industrial sectors like GICS classification, MSCI level 4, etc. And knowledge graph that connects companies based on share ownership. We can build a covariance matrix that imposes this structure for each of the knowledge graphs. So that means that we would end with 5, 10 different covariance matrices, not one covariance matrix that is based on historical observations, but we will end up with many different covariance matrices that are benefiting from this forward-looking information. You see, when we operate with a knowledge graph that links companies based on their supply chain connection. Whenever there is a change, like for instance, a company changes a supplier or two companies merger, etc., this is instantly adjusted, and a covariance matrix is recomputed in real time and is forward-looking. We will have a collection of covariance matrices where all of them are forward-looking, not like the traditional ones that you download from Bar, etc., that are backwards-looking. These are forward-looking. And then when we make our allocation decision, it's based on an ensemble of all of these covariance matrices. I think that this is much richer, adaptive, forward-looking, dynamic than the approach that is typically utilized in the financial industry. If you found this topic interesting, I would suggest that you read these two books, Advances in Financial Machine Learning and Machine Learning for Asset Managers. Thank you for your attention.